Welcome back to the Pro Ticker Podcast, your Tuesday morning edition covering major financial magazine headlines, everyone.
Yeah, it's certainly a busy morning on the desk today. Good to be here.
That is, that's putting it mildly. It is Tuesday, February 24th, 2026. And if you've glanced at your terminal, your phone, or really even just caught a glimpse of a TV screen at the airport this morning, you are seeing a sea of red.
Just red everywhere you look.
Everywhere. The market atmosphere right now feels less like a standard correction and more like a perfect storm of anxiety. It kind of feels like the market woke up, realized it was late for a meeting, tripped over the cat, and just spilled hot coffee on itself all before 8 a.m.
That is a very vivid image.
Yeah.
But honestly, it's not far off. We're looking at a convergence of pressures that we haven't seen align quite like this in a while.
Right.
Usually you get one crisis at a time.
Yeah.
Like a tech sell-off or maybe a geopolitical flare-up. But right now we're getting everything everywhere all at once.
Exactly. And that's why we're pulling apart a fresh stack of reports from CNBC and Bloomberg today to really make sense of it. And the mission for this deep dive is pretty specific for you all listening. We aren't here to just tell you stocks are down. You can see that on the ticker.
Yeah, that's the easy part.
Right. We need to synthesize why they are down, because when you peel back the layers of this particular news cycle, you find three distinct, really destabilizing forces hitting the global economy simultaneously.
Exactly. You've got the AI narrative shifting from unlimited opportunity to tangible disruption. Then you have a trade war that has suddenly morphed into a legal quagmire involving the Supreme Court.
Yeah.
And third, you have genuine kinetic geopolitical escalation in the Middle East.
It is the absolute trifecta of stress. So let's start with the scoreboard, just to set the context for you. Yesterday was brutal.
Broad-based sell-off. Nowhere to hide.
The S&P 500 gave up 1.04%, the Nasdaq shed 1.13%, and the Dow really took the hardest hit, dropping 1.66%. And Asian markets were mixed overnight, which offered zero relief or direction.
And that lack of direction is the key takeaway there. I was actually reading a note from Jim Cramer this morning that summed up the sentiment perfectly. He used one specific word to describe the current market structure, and that word was fragile.
Fragile. That's an interesting choice of words given the sheer highs we were hitting just a few weeks ago. I mean, usually when we are at all-time highs, people talk about strength and resilience.
Well, that's exactly his point. He argues that despite those highs, the market structure underneath has become incredibly brittle. It doesn't take a massive systemic shock to knock it over anymore. It just takes a stiff breeze because investors are already primed to flee. The liquidity is there, but the confidence just isn't.
And right now, we obviously have more than a breeze. We have what analysts are calling the twin fears.
Right. Fear number one is the tangible anxiety over AI disruption, specifically regarding OpenAI and Anthropic, which is a story we definitely need to spend some real time on because it changes the whole thesis.
Definitely.
And fear number two is the confusion over tariffs.
It's worth noting here for the listeners that markets can usually price in bad news. If you tell the market taxes are going up to 30%, it adjusts the models and moves on. But confusion is a totally different animal.
Confusion is uninvestable. You cannot build a discounted cash flow model on the word maybe. You can't price in a policy that changes every 12 hours.
And to validate that exact sentiment, we had Jamie Dimon weighing in. And when the CEO of JP Morgan speaks, the street usually stops to listen. He's seen a few cycles in his time.
He certainly has. And he did not offer much comfort this time around.
No, he didn't. He was quoted saying, "My anxiety is high." And he explicitly warned investors to watch out.
Which is incredibly significant. Dimon isn't usually an alarmist. He's usually the ultimate cheerleader for the American economy. His point here is that we have incredibly lofty asset prices. Stocks are expensive by historical standards. Real estate is very expensive. And these valuations are colliding head-on with these new economic risks. When the head of the country's biggest bank says his anxiety is high, it moves the needle from just Twitter noise to serious institutional concern.
It really validates the feeling that something is off. Let's drill down into that first fear you mentioned, the AI disruption. For the last 2 years, the AI trade has basically been a gold rush. Buy the chip makers, buy the software, buy the infrastructure. It was very much a rising tide lifts all boats phase.
Exactly. It was all about the infrastructure build-out. Everyone wins because everyone is just buying shovels for the gold rush.
But looking at the tape yesterday, specifically with IBM, it feels like that narrative just shifted entirely.
It absolutely did. We saw the dark side of the moon yesterday. IBM, which is a legacy blue-chip tech giant, tanked 13% in a single session.
13% for a company of that size is a full-on crash. That wipes out billions in value in a matter of hours. And this wasn't an earnings miss.
No, this wasn't bad accounting or a CEO scandal or anything like that. This was triggered by a specific threat from a new programming language released by Anthropic.
Help the listener understand the connection there. Why does a programming language from a startup knock billions off IBM's market cap? IBM has been around for a century.
You have to look at IBM's revenue mix. A massive chunk of their business is consulting and services. Essentially, charging really high hourly rates for human experts to write code, manage systems, and integrate software. It's a business built on human capital complexity.
High-margin human capital. They bill for the hours and the deep expertise.
Precisely. And the market looked at this new tool from Anthropic and realized, wait a minute, this tool does exactly what IBM's armies of consultants do, but it does it for pennies and in a matter of seconds.
So the fear has transitioned from something theoretical to purely operational.
Correct. Until now, the AI fear was abstract. It was like, will robots take jobs in 2030? This drop signals that investors are pricing in the immediate destruction of legacy business models right now.
Wow.
It's no longer about who wins the AI race. It's about who gets crushed by it. If an AI can code better and faster than a human consultant, IBM's moat dries up overnight.
That is a terrifying realization for the entire service economy. And it implies a re-rating of risk for the whole legacy tech sector. I notice Apple is also struggling in these reports.
They are. Apple is down about 2% to start 2026, but more importantly, they are off nearly 8% from their December highs.
Which suggests this isn't isolated to just the old guard of enterprise tech like an IBM.
No, it shows the market is hunting for weakness everywhere. Even cash-rich giants aren't immune. If the sentiment shifts from AI will help you sell more iPhones to AI might make your app ecosystem less relevant. The honeymoon phase is officially over.
Yeah.
Now we are in the prove you can survive phase. Investors are looking at these balance sheets and asking, is your core product about to be automated away?
That is a very heavy question for any CEO right now. Let's pivot to the second major stressor from our sources, the trade chaos. And I use the word chaos intentionally because this situation with the tariffs has gotten legally bizarre.
Bizarre is a good word for it.
Yeah.
This involves the Supreme Court, FedEx, and potentially the solvency of the U.S. Treasury.
So catch us up. The Supreme Court ruled that some of President Trump's tariffs were actually illegal. That was the first domino.
A huge blow to the administration's trade strategy, yes. But the real story is the corporate reaction. On Monday, FedEx, which is one of the largest logistics companies on the planet, sued the U.S. government.
That is a bold move. You don't usually sue your regulator unless you think you have a slam dunk case. What is the basis of their suit?
They are seeking a full refund.
A refund of the tariffs they already paid.
Yes. Their legal argument is incredibly straightforward. Since the Supreme Court deemed those tariffs illegal, the government had no right to collect that money in the first place, and therefore they want it back.
We aren't talking about small change here. FedEx moves a staggering amount of goods.
We are talking about billions of dollars. And FedEx is just the first major American company to file. Think about the implications for a second. If this precedent holds, every retailer, every manufacturer, every logistics firm that paid these tariffs will line up for a refund.
It creates a massive, totally unexpected liability for the U.S. Treasury. It's like the government suddenly receiving a bill for 5 years of back taxes from corporate America.
Exactly. But let's look at the political response, because Bloomberg is reporting that the Trump administration isn't taking this lying down. They aren't just going to write the check.
No, I imagine not. What's the countermove?
Trump is reportedly eyeing new trade probes. Essentially, he wants to find a different legal mechanism, likely under national security statutes, to revive the tariffs and completely circumvent the court's ruling.
And part of this proposal involves a flat global duty, right?
Yes, raising global duties to a flat 15%.
I want to pause on this because there is a counterintuitive dynamic here that the sources call the ally paradox.
This is critical to understand. On paper, a flat 15% global tariff sounds like it hits everyone equally. It sounds fair, but in practice, it punishes our friends and helps our rivals.
Walk us through the math on that. Why does equal mean unfair in this specific context?
Sure. Take a country like the UK, or a member of the European Union. Under current trade agreements and our generally friendly status, they might face very low tariffs, say on average 2 or 3%. If you slap a flat 15% duty on them, that is a massive tax hike. You are tripling or quadrupling their cost to enter the U.S. market.
Right. It walls them off.
But now look at a rival like China, Under Section 301 or other specific punitive tariffs enacted over the last few years, they might be facing duties of 25% or more on certain goods. If the U.S. switches to a flat 15% global rate, that could actually represent a decrease in levies for them relative to the current highs.
So we would be effectively lowering taxes on competitors and raising them on allies.
In specific contexts, yes. And you can imagine how that is playing out in diplomatic circles.
I'd assume not well.
Not well at all. The EU is already stating they are ready to retaliate, claiming the U.S. has breached existing trade deals. So you have legal battles at home with FedEx and diplomatic battles abroad with Europe.
It creates an environment where companies simply don't know the rules of the game. If you're a CEO, do you build a factory in Vietnam? Do you build it in Mexico? In Ohio?
Yeah.
You can't decide because the tariff rate might change by 15% tomorrow morning.
And when companies don't know the rules, they pause investment. They hoard cash. That is the ultimate drag on the economy.
Speaking of pausing investment, let's look at the asset class that usually acts as the canary in the coal mine for risk sentiment: crypto.
Bitcoin took a significant tumble.
It fell over 5%, dropping below $63,000. Now, usually the crypto faithful scream by the dip, but the analyst notes we have here are singing a very different tune.
They are. Christopher Hamilton from Invesco put out a note calling this tactical de-risking.
Which is Wall Street speak for what, exactly?
It means sell the stuff that moves the most. When the macro picture gets scary, institutional investors dump their highest beta assets first. Bitcoin is still considered a high-risk, high-volatility asset.
So this isn't about Bitcoin's fundamentals. It's not an exchange hack or a new regulatory crackdown.
No. Hamilton calls it a classic risk sentiment reset. It's entirely macro-driven. Investors are raising cash because they are worried about the third pillar of this storm, which is geopolitics.
The Middle East.
Specifically, the escalation timeline. President Trump made a statement that he would determine within 10 days whether to launch a strike on Iran.
That is a very specific, very short countdown.
Markets absolutely hate countdowns to potential conflict. It puts a literal clock on volatility. It forces traders to ask, do I want to be holding this asset 10 days from now if missiles start flying?
And we're seeing movement on the ground, not just rhetoric.
Right. Washington is currently deploying military assets across the region. And while oil prices retreated slightly on Monday, they're still carrying a heavy risk premium. The Iran-related supply fears are keeping energy prices elevated.
If a strike happens and the Strait of Hormuz gets complicated, oil spikes. And if oil spikes...
inflation comes roaring back.
Exactly.
And the Fed's hands are tied at that point. They can't cut rates if oil is at $100 a barrel. It's a nightmare scenario for the central bank.
There was another geopolitical note in the sources that I really don't want to gloss over. It's about the Panama Canal. It seems small compared to Iran, but the implications are huge.
A very significant development.
Yeah.
Panama canceled a China-linked port deal.
And they handed the operation of those canal terminals over to Maersk and MSC.
This is a clear signal of the U.S. sphere of influence reasserting itself over critical infrastructure in the Western Hemisphere. For years, the narrative was that China was buying up ports everywhere. Africa, South America, even Europe.
This feels like a major strategic correction.
It is. Moving away from Chinese control and handing the keys to European-based shipping giants plays into that broader theme of global trade fragmentation.
The world is splitting into blocks,
Yeah.
friendshoring as they call it.
Exactly. And while that might be good for national security, it makes global supply chains more expensive and far less efficient. It adds friction to everything.
I want to pivot now. We've covered the global meltdown, from AI to tariffs to war, but there is a domestic policy battle brewing that affects you, the listener, and your wallet directly: housing.
This is turning into a massive bipartisan battleground. Everyone knows housing is too expensive.
We have dueling proposals on the table right now to fix this affordability crisis, and they are radically different in their approach.
They are. Both sides have essentially identified the exact same villain, which is the corporate landlord. But the weapons they want to use against them are totally different.
Let's start with the Democrats' proposal. We have Elizabeth Warren and Jeff Merkley leading the charge. What is their plan?
Their plan is to weaponize the tax code. They want to end tax benefits for major corporations that own more than 50 single-family rental homes.
So they're going after the depreciation write-offs and the mortgage interest deductions.
Exactly. If you are Wall Street and you are hoarding houses, the Democrats want to make it incredibly tax inefficient. They also want to bar these companies from accessing federally backed mortgages, essentially cutting off their cheap leverage.
The strategy is to squeeze their margins until they are forced to sell the inventory back to regular families. Now, contrast that with the Trump administration's plan.
Trump's proposal is a blunt instrument. He is proposing a ban on institutional investors with more than 100 single-family homes from buying new ones.
A straight-up purchasing ban. Just no more buying for you.
Yes. However, and this is a massive, however, there is a loophole. The ban includes exceptions for companies that increase the number of single-family homes.
Meaning home builders.
Correct. The logic is supply side. They don't want to discourage new construction. So if you build the neighborhood, you can own the neighborhood.
Critics would argue that just incentivizes big developers to build rental-only empires rather than selling to families.
That is the big risk. It potentially creates a massive class of build-to-rent giants. But for the market, specifically the real estate sector, this creates a very confusing regulatory landscape. Are we taxing them? Are we banning them? Or are we incentivizing them to build?
Again, regulatory uncertainty is the theme of the day.
It really is. It makes it very hard to value a company like Invitation Homes or American Homes 4 Rent when you literally don't know if their business model will be legal next year.
Before we wrap up, I want to touch on investor psychology. Because despite all this bad news, despite the fragility Cramer talked about, the retail crowd is still taking massive risks.
This was one of the most surprising stats in the stack today. There was a report from Direction regarding leveraged funds.
For the listener who might not use these are the ETFs that aim to return 300% of the daily movement of a specific index or sector.
High-risk, high-octane instruments. They're designed for day trading, not for holding. And the report says active leveraged funds grew by 50% in 2025.
That is staggering growth for such a niche, dangerous product.
It suggests a casino mentality has taken hold. We are seeing everyday traders increasingly using 3x leveraged funds to basically buy the dip.
I saw a specific example in the notes that made me double take. The daily South Korea Bull 3x shares, the ticker is KRU.
Right. Traders are trying to time international rallies with triple leverage during a global trade war.
What is the expert take on this? Is this just aggressive trading or is it fundamentally dangerous?
It's conditioning. Since the pandemic, every time the market has dropped, it has snapped back up. Investors have been trained to treat the market like a rubber band. They think red means immediate opportunity.
The classic stonks only go up mentality.
Exactly. But the caution here is that this behavior is incredibly risky when the shocks are structural rather than temporary.
Meaning, if the market drops because of a temporary scare, buying the dip works. But if it drops because AI just permanently erased IBM's business model,
then the rubber band doesn't snap back. It breaks. And if you are holding a 3x leveraged fund when the market slides and stays down, you get wiped out. You can lose 30, 40, 50% in a matter of days.
It's like picking up pennies in front of a steamroller.
And right now, with tariffs, AI, and Iran all in the mix, that steamroller is moving pretty fast.
So let's synthesize this for everyone listening. We have a legal crisis with FedEx challenging the government's revenue stream. We have a tech crisis with IBM showing us the deflationary power of AI. And we have a geopolitical crisis with Iran.
It is a lot to digest. The key takeaway for you listening is that volatility is likely here to stay. This isn't a wait it out for a week kind of situation. These are structural changes to how the world works.
Looking ahead to tomorrow, what is the one thing we should be watching?
Watch Home Depot earnings. They report Tuesday morning.
Why Home Depot specifically?
Because they were the ultimate proxy for the American consumer's confidence in their own home equity and job security. If people are spending money on renovations, they feel rich, they feel secure. If Home Depot misses, it means the consumer's pulling back.
And in an economy that is 70% consumption, if the consumer pulls back, that is the final pillar to fall.
Exactly. And also keep an eye on that mad money sentiment. If Cramer is calling the market fragile today, see if that tone shifts if we get any positive headlines. Sentiment is driving the bus right now.
You know, before we go, I have a provocative thought for you to chew on and for our listeners to think about.
Let's hear it.
We talked about FedEx suing for a refund. Imagine they win. Imagine the floodgates open and the U.S. government has to refund billions, maybe hundreds of billions, in tariff revenue to corporations.
It's a staggering amount of money.
We already run a massive deficit. If the Treasury suddenly has to write checks for billions of dollars back to FedEx and Walmart, what does that do to the bond market?
That is the trillion-dollar question. If the Treasury has to pay out that cash, they have to borrow it. They have to issue more debt.
And more supply of debt usually means lower prices and higher yields.
Exactly. Yields would likely spike, and if Treasury yields spike, mortgage rates go up.
So the housing crisis we just talked about gets even worse.
It is all connected. A court ruling on tariffs can ultimately dictate the interest rate on your mortgage.
That is a very sobering thought to leave you with. Everything affects everything.
Indeed. Keep your eyes open out there.
We'll see you all tomorrow morning with new headlines from major financial magazines.